Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah, and the talking point today is what kind of a cycle has cement as a space entered into. Rakesh Arora of India Advisors has written a very interesting note wherein he's compared a lot of historical step ups that have happened in the costs and the pricing scenario, which have ultimately led to some form of cycle creation for the sector and from a share price return perspective. And I requested him to talk about that today on the show. We have him. Rakesh, thanks so much for joining us today.
Good.
So Rakesh, it's counterintuitive that the creation of a cycle happens because cost pressures get mounted on a sector, and that's what you kind of laid out in your note. Can you talk a bit about it?
Yeah, so see, I still remember when I used to work in cement industry in 1990s. We used to think in terms of 2 rupee, 3 rupee per bag price increases. So that was the mindset of the cement industry at that time. And while say attempts for having a supply discipline was always there, but the mindset was not there. But something clicked in 2004, 2005, and that was when the current government at that time in banned overloading of trucks. Now suddenly the freight rate went up by 80%. Meaning in a truck which was allowed or passed for 9 tons, you were loading 18 tons. And so remember that apart from the diesel, the large cost is actually driver cost and the interest and depreciation on the truck. So diesel cost is only like 30%. Or at that time, it used to be even less. So if you could double load a truck, your cost of freight used to be meaningfully lower. So that really led to a sharp jump in cement price. So we were trading at around say 140 rupee per bag before that. We jumped to around 235. So a jump of 100 rupees, which in terms of rupees per ton is pretty significant. It's like 2,000 rupees per ton. So that's a very significant jump. Fortunately, at that time there was also tailwind because Indian growth, global growth, everything was going up, and capacity utilization in cement was around touching 90%. So there was a tailwind. So that's why this big jump actually came through. After that, cement prices stagnated post the global financial crisis for a pretty long time. And inflation was a big worry. You might recall that inflation was running in double digits. And then Finance Minister, Mr. P. Chidambaram, he tried every, trick in the book to, curtail prices. Many current government has also done like export taxes and all that thing. But in cement, the problem is there's no export, there's no import. So levers are very limited. So Mr. Chidambaram is a very smart person. He came out with a formula that if prices jumped beyond a certain level, the excise duty jumped by a big step up. Now that allowed industry to take that big jump of 20 rupees per bag, and after that they never saw back. So now after the tweak in the excise duty at that time, industry became comfortable with 20, 30 rupee price jumps per bag. So that was the second trigger where prices went up to around 350, 360, where they are currently stable for last 7, 8 years. Now coal prices have actually gone up like 4x, 5x, and we are 100% sure that they can't stay at that level. But cement prices have taken a jump from 360 to 400 plus. The current government has beaten them into not taking the prices too high. But as inflation worries recede and as we are getting into busy season, prices are already starting to go up again. So the implication is that before 2004, industry used to make 400 rupees per ton. Post global financial crisis and after the jump, they used to make around 800, 900. Post the excise duty increase, they started making 1,000, 1,100. Shree Cement was doing like 1,400. And now I think the industry will move to 1400 to 1500 rupees per ton. So this big step up that we are seeing because of cost pressure, because cement prices once they go, they remain stuck. They don't change for a few years. And so this is the big step which we made us bullish even before the Ambuja acquisition was announced. So that was our bull call. And this Adani acquisition of Ambuja is adding spice to the whole thing.
Yeah. And I remember our conversation, Rakesh, wherein you had said that you were surprised that analyst community has not gone down in a hurry, and given the upgrades post that acquisition was done, the stocks have, of course, duly reacted in the last few weeks, if you will. But just okay. So let me just kind of dwell in on this a bit. How does a typical cement cycle therefore work? Is there a pattern to this that once it enters into what arguably could be called a good cycle, whether it's a demand led, whether it's cost and pricing led or otherwise, does it stay on for a particular period of time, or there is no such predictability possible?
So as I was saying, before 2004, it was more demand supply led, and but the variations are very limited. Meaning it's like between 5-7% plus minus. So obviously, in a lean season, it will go down. In a busy season, it will go up. So the correlation to demand supply has weakened in the last 2 decades because there's been more consolidation happening in the industry. Ultratech has been a big consolidator, and Dalmia and Shree have really come up in a big way in terms of gaining market share. And Ambuja and ACC under Wholesome were kind of standing at a certain place. So the top five now control 50% of the industry. So there's much more higher discipline. And these guys have understood the game that, volume is not the way to make money. It's more about pricing. And fortunately, they had Wholesome, which was a willing, player giving away market share. So there was no problem even on the volume side. So right now, I think industry is very much, kind of disciplined on the pricing. So I don't think prices are going to move too much. And the way our capacity and demand for cement is increasing, adding capacity is going to be a challenge. That is what I think.
And yet we have had the Adani Group go out and say that they will double the capacity in the next 5 years. And I mean, on that base, it's not. It's quite a meaningful capacity addition, Rakesh.
So India's capacity is around 500 million ton and demand is around 400. So you produce around 400. So in next 5 years, assuming you grow at around 8% CAGR for demand, you need around 40 million ton every year. So in next 5 years, you need 200 million ton. Now, Ambuja and ACC have around 16% market share. So 16% market share means they have to add almost 32 million ton out of this 200. So from currently 70, they go to around 100 million ton just on the organic thing. Now suppose they add another 10 to 20 extra. So you're talking about a market share gain of only like 1 to 2% in 5 years. Whereas Ambuja and ACC have lost around 8% in last 15 years. So they were at 24% market share, they've gone to 16. Probably under Adani, they'll go to 18 or maybe 20 if very aggressive in 10 years. So we are not really talking about too much of a market share gain, despite talking these big numbers. So, the market is fixated on the large numbers which Adani is saying. But if you calculate, it's not really that big deal in terms of market shares.
Got it. Yeah, but if they gain the market share, then somebody will lose out. It'll be interesting to see whether it's the small regional fringe players or otherwise. What's your sense of that?
It will be a small regional players who will lose out market share. Plus, also remember that Adani would acquire few other companies. So it will have their growth also come in into the whole growth.
Got it. Okay. Fair call. Now, Rakesh, actually turning the clock back a little bit to the valuations first before I talk about the challenges thereof. The interesting part that I read about in your note is that while people may look at the recency bias might compel people to look at the last 2 3 months and say, "Hey, there has been quite a bit of a run up," but on on historical averages of valuations, some of these stocks are not really have not really perked up too much in terms of being in the egregious valuation zone. Is that probably one reason why you use the term re-rating for the space?
So, I mean, if you look at last 10, 15 years, Shree Cement has gone up 20 times. Ambuja has gone up 2.5 times. So there has been a massive de-rating which has happened because Ambuja was growing its volume at around 4 to 5% and making around 1,000 rupees. Shree was growing at 14%, making around 1,300 rupees per ton. So they were making 300 rupees per ton extra, and they were growing at 10 percentage point extra on volume. Now, if you look at Adani's speech, Mr. Gautam Adani, he has made it very clear. He is looking for both cost leadership and also volume leadership. So if Ambuja was trading at around 15 time EV beta in the last 5-10 years, and Shree was trading at say 25 times, I see no reason why if Ambuja turns the clock on its margins and volume growth, why it should trade any discount to Shree. So that is the reason I use the term re-rating. I think it will trade at around 25 times. Currently, Ultratech has been trading at around 19, 20 times in the last 5-10 years on EV/EBITDA. Currently, it is trading at a lower level of 17 times or so. It's got derated a little bit because all the cost pressures and people are focused on the near term. Ambuja, obviously, because of the deal, has seen slight outperformance. But from a longer term perspective, I see there's still long way to go before this re-rating is complete. And see, I'm not talking about Adani Premium here. I'm just talking about where the others in the industry are trading.
Okay. By the way, viewers, standard disclaimer, the Adani Group owns 49% of Quintillion Business Media, which owns BQ Prime, which is the platform that I'm conducting this show on. So just wanted to lay that out. But Rakesh, here's a question. In its history, Shree Cement kind of turned out to be an exceptional cement stock, right? Because of the way it maintained the ratios, maintained debt levels while going on this capacity expansion and all of that. So you reckon that the multiples that it commanded were warranted, and do you reckon that it's that the market could give similar valuations to other players as well? Because the return ratios, the margins, the debt levels, etc., everything might be different for other players compared to a Shree.
Excellent question, Neeraj, because Adani is going to do better than Shree on a lot of counts. So let's take first the volume growth. Shree was never aggressive in inorganic growth. So Shree grew only organically. So if Shree can grow at 14, I think Adani will grow at 20 because of inorganic growth. So that is one. Let's come to margins. She was able to control margins because of two things. One, they were early movers in petcoke consumption. They replaced costlier coal with petcoke, which is more polluting, but it's cheaper. And secondly, they were very efficient in their logistics. They continued to overload trucks, etc. Because government came out with a golden pass scheme later on. You pay some fine and you are okay with it. I think Adani on these two counts also is going to do much better because one, they control majority of coal imports into India. So nobody can buy better priced coal than them. Number two is logistics. They are the masters of logistics. Sea freight is the cheapest way to transport cement. Ambuja was a pioneer, and that was the reason why they become such a successful company when they started shipping of cement in 1986. Their margins were like 200 rupee per ton higher than ACC, which was like number one company at that time. So I think Adani is going to go all out with its sister concerns in terms of their expertise in logistics. to cut cost. The third is power cost. And I don't think anybody can beat Adani in terms of renewable power. So if you combine all this logistics, renewable power for running the cement plant, and you know acquiring coal, I don't think Shri can beat Adani in the cost structure. I think now Ambuja under Adani can do higher margins than Shri by 100 to 200 rupee per ton. That is what I think is possible. Obviously, execution is the risk. Yeah. The third factor which really matters in terms of your return on equities is leverage. Shri has always been running an under leveraged balance sheet. So ideally their return should have been like 17-18% ROE, but because of the under leverage they were running at 13% ROE. I think Adani's will run a much tighter ship on the balance sheet. So on capital efficiency, on operating efficiency, and in terms of aggression on volume growth, I think Adani under Ambuja under Adani should trade at a much higher multiple than Shri, because of all these factors that we discussed.
Got it. But you are constructive on the space at large. It's not just Ambuja and Adani. You are constructive on multiple other players on the space at large, right?
Exactly. So meaning we became bullish, as I told you, even before this acquisition, because of the step up that we are expecting in margins for the industry. So obviously everybody will benefit out of it. And so it's not to say that others are not good, but I'm saying that here is a re-rating potential candidate.
Got it. And Rakesh, how long would this cycle typically last? I mean, if this is a cycle you look at these industry in cycles as well. If you do, how long could this potential cycle last? Because India is arguably going on a capex drive, but in an environment which is shaky on the global front, and therefore one doesn't quite know how things would turn out over the course of the next 12 to 18 months, even if the medium term looks more robust.
See, India is not China. It grows at its own pace. So GDP growth would be like 6% or 7%. And cement demand is going to grow at 1.2 times at the best. So we are talking about 7 to 8% demand growth. So cement demand is not going to really vary too much, whatever happens globally, because if things are so bad, Indian government is going to support the domestic economy through infrastructure, etc. So cement is kind of immune to the global, worries, I would say, and that is the reason people are giving cement such a high multiple as compared to other global commodities, because there's a lot of certainty. Now, if you look at the cement stock prices, they also move in a step up along with the cement prices. So as the step up is happening on the margin, which will play out in the next year or so, cement stocks will also jump up and then kind of stabilize at that level till the next step up comes in. Or if somebody is growing aggressively, then that's a different matter. So normally these step ups happen in a period of 12 to 18 months, and I think that is where large part of the returns will be made in the cement stocks.
Got it. Great. Rakesh, any risks to this beliefs that you just laid out?
Now, see, the risk is that if existing players want to make it hard for Adani to gain market share, to grow, already yesterday the news was that he has pledged everything that he owns in Ambuja and ACC. So it's wait and watch what other players do. But looking at the political clout, the business sense which Adanis have, I don't think they'll get into any kind of price war or even a volume war.
You had mentioned earlier as well that you don't believe that Adanis will fight a pricing war game. Like 2 months earlier when we spoke, you had mentioned this, that you don't foresee a price war between competitors in India.
Meaning, see, they will be the lowest cost producer. It will be difficult for anybody to dislodge. And see, if Ultratech has to fight the war, they lose 2x. Because this guy is selling 55 million ton. They are selling 110.
That's true.
So for them, it's much more to lose than Adani alone. So it makes no sense actually to. And see, cement is not that you can expand anyway. You need limestone. You need to do a lot of groundwork.
That's true.
Yeah. So it's not that capacities can come overnight.
Yeah. So I've last two questions, Rakesh. One is on other players expanding capacity. We've spoken it from what the Ambuja would do, but Ultratech has said that they want to increase capacity as well. Some other players have come out and said that they are looking to do that, if not now, then over the medium term. Is there a case or is there a possibility of we reaching some bit of a glut-like situation in the next 5 years sometime, or no, not really?
No, so as we were discussing that we need around 200 million ton, and the top five players will have to do the heavy lifting. So in any case, they have to do 50% to maintain market share, which is like 100 million.
Got it.
40, this guy would do 40, Ultratech would do 10, 15, Shri and this guy, Dalmia would do. So, and as I told you that, demand supply correlation has weakened quite a bit.
Got it.
So 1 or 2 percentage point here and there doesn't matter too much.
Okay. My final question is on M&A activity. Now, there is a heightened chatter every third day. There is a small cement company being put on the block. My question is, I'm sure if, the cement industry, people also understand the kind of cycle that we might be in for, right? So the seller will not be available at the valuations that a buyer would necessarily see, right? So my question is, does it therefore reduce the chances of inorganic moves by large players to acquire smaller players, or you still think that will happen?
It will happen, but see, it will be very opportunistic. So none of the cement companies are in high distress. There are few which are in small distress, but not really like a very high distress scenario that they have to immediately sell out. See, Jayaprakash was the last one which was in high distress, and then Binani came in. They've all been acquired in distress. Now, there will be acquisitions, but remember that Ultratech is also now a pan-India company. Adani is also now a pan-India company. So CCI approvals will be difficult to come by.
That's true.
So for Adani's, if I think, the pocket of opportunity is in South India, in Northeast, and a little bit in Central India, more near like UP, etc., where Ambuja and ACC are not present in a big way. So these are the three pockets. So viewers can actually figure out, which are the companies in these pockets. Similarly, in Ultratech will also meaning I don't think anybody is going to pay top dollars to acquire anything.
Got it. Rakesh, conversations with you are always insightful, whether it's metals, whether it's cement, or even general markets. So thank you for your time today and giving us a lowdown on the space.
Thank you, Neeraj. Thank you.
Much appreciate. Viewers, thank you so much for tuning into this edition of The Talking Point.